Hello, everyone, and thank you all for joining us for this morning's IIF ESG webinar. We hope you're all staying healthy and safe. This webinar series is designed to promote understanding of the rapidly evolving landscape for key policy and regulatory initiatives in sustainable finance and ESG disclosure, and to help with alignment of efforts to measure and track climate finance. Joining us for today's discussion for how essential good data is to the sustainable finance ecosystem is Leon Saunders-Calvert, who is Head of Sustainable Finance at Refinitiv. I'll just open for a few quick questions for Leon, and after which he'll tell us more about Refinitiv's ESG data and modeling. After Leon's remarks, there'll be a Q&A session. We'll get to as many as we can, but we'll stick firmly to half an hour for this call. Just two quick logistical points. First, this discussion is on the record and members of the press will be in attendance. And second, questions can be submitted for those of you who are joining via video conference with the Q&A function at the bottom of the screen. So Leon, first question for you. Where are you joining us from today and how are you faring as lockdown continues?
Thank you very much. I'm delighted to be here. I'm joining you from the suburbs of London. You know, with my family in tow and in the house, and we're all coping just fine. I'm sure very similar to lots of others, but thanks for the question.
So before you get started with your slides, which I think will be absolutely fascinating for the group, one general question for you, just to kind of frame it all. We put out at the IIF a paper on the sustainable finance pyramid, which is a framework we use to think through the essential parts of the ESG ecosystem, including data, disclosure, taxonomy, and methodology. And data is really fundamental to all of this, having good and comparable complete ESG data. Why does Refinitiv focus so much on this, on the fact that quality data is so essential to sustainable finance?
Look, I think the question is an important one, but I also hope it's relatively sort of self-explanatory in terms of the importance. Why do I say that? Well, Refinitiv, in its various guises, Refinitiv is obviously the spin out of the financial and risk business of what was previously Thomson Reuters, the Thomson Reuters financial and risk business, and then has a very, very rich history, 160 plus year history in providing transparency to markets and allowing for, I think, what I describe as the ability to raise new capital and the optimization of the allocation of capital in financial markets, and to do that, to drive transparency into that process. And that's what Refinitiv has stood for you know, for that period of time, for you know, nearly 2 centuries. And ESG and sustainable finance is in some sense no different. I don't mean to imply that it's not new and it's not important, but it needs to be treated with the same level of focus, which is this drive for transparency. How can you possibly optimize the allocation of capital appropriately to drive these outcomes and measure impact if you're not using data to do that? And so treating the data with that level of investment grade focus, with that level of fundamental focus, hence the name of the presentation today, the ESG fundamentals, we think is completely critical and central to supporting the financial market's ability to deploy capital in the most optimized way.
Indeed, so many efforts in progress in this space. Well, why don't you take us through your slides, Leon?
So look, I figured I'd just start off with just talking at a high level about some of the fundamental dynamics of the market. And then I would take you into a little bit more of detail of, well, how's Refinitiv approaching this space? And then, of course, we'll leave time for Q&A. I think it's kind of useful to sort of let's level set across a few things. The first thing is, of course, that the amount of capital, the amount of assets under management, which is being deployed to sustainable finance, sustainable investing, is growing and is growing rapidly. And that growth continues into 2019, 2020. Indeed, flows into ESG funds and investment strategies have actually increased over the course of the COVID-19 crisis, and largely decreased, of course. Fund flows have decreased more broadly outside of ESG funds. But this growth continues even now and even in this crisis. There are a few ways to think about the sustainable finance agenda. One of which is, of course, that a lot of these funds that identify themselves, or portfolio strategies that identify themselves as ESG are in some way identifying the fact that they are tracking and measuring outcomes which are above and beyond just pure financial performance and financial returns. It's not that they don't care about financial performance and financial returns, just to be clear, but by definition, if you identify yourself as a fund driving for sustainable outcomes in some way, shape, or form, then you're also measuring something else. It may be ESG as a whole, it may just be climate, it may be other issues, it may be resource use, it may be diversity and inclusion, it could be any number of things. But either way, you're measuring something which has values associated to it, ethical values in some way, which you want to track and measure your progress around, as well as your financial performance. And that's largely what we talk about when we talk about ESG funds under management, or sustainable investing funds under management, and the growth of that. That means that you've got more and more funds which are measuring themselves against those additional criteria. You've also, however, got all of the rest of the assets under management, all of the rest of the 70% of the world's assets under management are focused, theoretically, they're just focused on valuations performance, effectively financial performance, and delivering financial performance back to their investors. But more and more, we're also seeing the market in that space is recognize that there are some ESG data points which are very, very meaningful to track if you want to manage your risk within your portfolio appropriately. And that might be purely a valuations issue. You're doing that purely for financial performance reasons, but indeed, if you can correlate risk and quantify that risk, and indeed potentially quantify and correlate alpha generation performance against some of these non-financial metrics, these non-financial ESG metrics, then of course you might want to factor those into the portfolio, even if the portfolio itself is not explicitly driving for sustainable finance outcomes. And of course, then you've got these sort of, what are the new tools? What are the new types of security? What are the new types of investable asset which we can create, which financial markets can create, which help identify how you can drive money into these sustainable outcomes? The most obvious of those products is, of course, something like green bonds. It's certainly not the only one, but it's one which has sort of got a degree of maturity around it in terms of people understanding what it is. But there's much more opportunity to establish securities which carry a green or a sustainable outlook. I highlight on this page, on the left-hand side of the page, I talk about sustainability as not being a new concept. It's not as if the term sustainability itself is new. It's just that the shift on it has the focus on it has shifted over the course of the last few years. So everyone used to talk about sustainability in terms of the ability for a company to meet its cash flows over the coming quarters, over the next few quarters, and make sure that you expected to be able to get your dividend payment out of it, that kind of thing. The shift that's taken place is really twofold. One is in terms of length of time of the period of time over which you're looking at the company performance, and the extended period of time over which you're looking at that company performance, from rather just the next couple of quarters and the expectation on your upcoming dividend statements in the near term, to a much longer term view of the sustainability of the business. And that's particularly important as you think about long-term investors with long-term investment strategies. They're not invested in the short term. They don't want to roll over their investments within their portfolio on a very rapid basis. They're intentionally not trying to do that, trying to pick sustainable investments which have longevity to them. And so looking at that long-term strategy then becomes really important. The other element is, of course, the number and breadth of stakeholders who you are now interested in servicing. So rather than just being focused on investors who are focused on short-term outcomes, you're now also focused on the employees, the customers of the company, the local community in which the company operates, and probably more broadly than the impact that the company has on both the local community, but potentially also at a global level, depending on the size of that organization. I've tried to identify, and I don't want to get overly bogged down in the semantics here, so I'm very happy for people to sort of disagree or question the definitions that I have on the page around sustainability, sustainable finance, and ESG. But just for sort of ease's sake, at least as it pertains to this presentation, I've tried to define what I think those things mean. Sustainability broadly about how do you continue to provide value and value-added services without compromising the ability for future generations to do so and for others to do so. Sustainable finance is around effectively allocating financial capital within the financial markets towards and around those outcomes, those sustainable outcomes. And environmental social governance, or ESG, is this material non-financial data on companies, on issuers, on securities, which helps to measure then that sustainable related footprint. I'll move on briefly, and I'll talk about some of the drivers in the market. I don't think any of these would be highly surprising, but hopefully useful to kind of bring them together. You've got a general awareness in not just in the financial markets, but actually in a general consumer behavior around issues such as climate change. That has now become sort of pertinent, and it's very, very difficult to have a conversation with anyone, not even just in financial markets, but outside of that, without the issue of climate and what does that mean and what are the challenges and how desperate is the situation and what needs to be done to solve it, being central to the dialogue, central to the conversation. It is now just part of the repertoire of the regular things which are discussed in the news, and so financial markets can't, so to speak, diversify away from the need to engage in that process. And there's also, at the same time, a sort of a reduced, if we think about ESG as a whole and don't make it only about climate, there's a reduced level of tolerance for things like inequality of opportunity. Just think over the last few years about things like the Me Too movement and things like that, the focus that brings on our companies behaving in the right way, giving everyone the right levels of opportunities to succeed, et cetera, et cetera. So you've got this general awareness in the markets around those issues. You've clearly got regulatory overhang on the market. The EU will be essentially the first to the financial markets to bring in some kind of regulation in the form of the EU taxonomy, but believe me, that's the start. That's not the end of regulation around what does good disclosure look like, what does mandatory disclosure look like for companies to have to disclose on, and indeed for financial service firms to have to disclose on in terms of their sustainability strategies, their sustainability footprint, and their strategies to deal with that. You've got this really interesting shift in capital to millennials. And it's very, very crude to talk about an overall generation versus a previous generation. And I don't want to get bogged down in trying to be sort of too generalistic here, but it's I think the reality is true enough that millennials have tended to care more about and ask more questions around purpose, and is my money being put to good work here, and I want it to deliver something for me above and beyond just returns. And those questions weren't asked so sort of aggressively and assertively prior to millennials starting to get their hands on money which they could invest in pensions and start to deploy for the purposes of savings. And of course that means that wealth advisors and the asset management industry at large all of a sudden had to be able to figure out how they had decent answers to those questions which they hadn't had to answer before. And of course the process of then understanding ESG data and how you measure the impact that you can make starts to become really important. And I think there's another issue here, which is active management, particularly in the States, but not only in the States, obviously, has been under massive stress, massive pressure from the passive space, particularly ETFs over the last few years. I'm not telling anyone anything they don't know, and hopefully I'm not saying anything controversial. I think that's a very uncontroversial statement. But of course, the ability for ESG data, material non-financial data, to be used as part of really intelligent decision-making around how capital is allocated in the long term, gives active managers an opportunity to really re-engage and reassert their ability to do something above and beyond what the passive space has been able to do, and demonstrate that they are worthy of capital being deployed to active management. So I think that's a really interesting dynamic here as well. Some of the requirements then of data providers, people like us around this space, well, there's an increased requirement for sophistication associated with ESG data, but it needs to be combined with ease of consumption. You don't want everyone to have a PhD and to know how to deal with ESG data and all the metrics associated with it to start to interpret how you're supposed to allocate capital accordingly. And so people like us figuring out how, yes, we're really robust with the data we collect, but also how do we make that really easily consumable in order to allow for the allocation within portfolios to drive the right outcomes. The example I tend to use is a very poor example, I think, but it helps make the point. Smartphones, incredibly sophisticated, and in order to chart your position on the globe, when you look at Google Maps or the equivalent app, it requires using Einstein's theory of relativity to find out exactly where you are and not get it wrong. And yet at the same time, my 7-year-old son knows how to use my smartphone pretty well. And so this combination of sophistication and ease are not in contradiction to one another, but it's not easy to do that, and that's the journey I think that we're all on here. Clearly, massive drive for transparency and disclosure and reporting standards, which relates, I think, to that that regulatory overhang that we see in the market that I described, and a lot of that also comes down to making sure not just which are the right data points to report, but when two different companies report the same data point, have they derived that data point in the same way? Do I know I'm comparing apples with apples? Those types of things are going to need to be addressed in the markets. There's a shift from thinking about ESG as being an alternative data set to actually being a fundamental data set, to treating it as, I've used this term a couple of times already, but I'll be more vehement with it, as just material non-financial data. That's the way that more and more asset managers, asset owners are starting to see this data. It happens to not be financial data, but is very material to investment decisions. It is fundamental data. And up until about a year ago, the buy side was so far in advance of the sell side of the investment banking community in terms of thinking about integrating ESG into their processes. And in the last year or so, there's been a really interesting sort of maturing process on the investment banking side, which I see continuing as the banks themselves start to think about what is their exposure to climate risk, particularly transition risk on their lending book, that type of thing, as well as how do I raise capital? How do I take advantage of the opportunity for this enormous capital creation that's needed in order to allow for this shift to take place? How can I be part of enabling the capital to be raised in the right places? And so the investment banks have started to get really, really interested in this now, which all I think contributes to the overall ecosystem maturity. So you've got a few challenges in the market. You've got by default in the data side, you've got a degree of fragmentation and inconsistency in the data in terms of are the two companies reporting scope 1 CO2 emissions in exactly the same way. You haven't got any clarity as to mandatory reporting from any regulators yet. Any regulation that does come in place is likely to come in place in certain regions before it hits other regions. So you've got sort of various different challenges around market dynamics, all of which Refinitiv is looking to address, both in the way that we collect data and try and standardize it, but also, quite frankly, it's a really important role for us to play in terms of working with industry bodies and working with regulators to try and help establish what good looks like in this space. And so that's also, it's worth pointing out, a really important part of the role that we play and how we organize ourselves. But three strategic pillars that we're focused on. One is to provide the most comprehensive security and issue level ESG data set in the world. The second relates very close to that ease of consumption point that I made on the last slide, which is the mainstreaming of sustainability metrics into financial markets. How do you make that data easy to consume and easy to make decisions off the back of? And I think that there's a particular then deep dive focus on climate risk. And there are two key forms of climate risk. There are more than this, and I'm sure people will correct me and say, there's others. But two key forms that I think are really important are transition risk, which is the risk of transitioning to a low carbon economy and how you manage that process. And then there is physical risk, which is as the effects of climate change do start to take place, rising sea levels, more extreme weather, what is the exposure that your company has or your supply chain of your company has to those risks? And that requires a whole level of focus in terms of data and analytics. And so I've made that sort of a third pillar and pulled that out for us. At its core, we cover about 9,000 companies globally and fast growing. We'll probably be about 10,000 companies in terms of coverage by the end of this year. We have a long history actually going back in this space. We acquired a company about a decade ago, which was way ahead of its time collecting ESG data and probably way ahead of market demand, quite frankly, for that data. But nevertheless, have been collecting data since 2002. So we've got a very big history of collecting ESG data. The data coverage that we have represents about 80% of global market cap. And we capture about 450 data points across the E, S, and G space. So, quite a broad, robust data set. I think one of the critical things as we start to make sense of that, though, is that 450 data points can be rather overwhelming. I've often sort of described that the danger is that we walk into, one of our clients, a big institutional asset manager, with a big box of all of our ESG data, and it looks like a huge box of Lego. We dump it on the desk, and it makes a big thud. But of course, the asset manager just does not know where to start with this, unless they're highly sophisticated themselves, unless they have, really good ideas of their own models of how they want to factor this data into their investment allocation processes. It's really hard to know what to do with that data. So one of the ways, certainly not the only way, one of the ways in which you can start to make sense of that data is to collate all those different data sets into components, into themes. And those themes I've tried to articulate on the slide, on the bottom half of this slide. It might be resource use, it might be emissions use, it might be environmental innovation. And there'll be a number of data points that you might collect underneath those, but which all add up to one of those themes. And you can score that theme based on a relative basis versus other companies in the sector, which might lead to then a score for overall environmental score versus a governance score versus a social score, which then it creates a composite score around ESG as a whole. I think that whilst I think scoring has a really important role to play to be able to identify good from bad, it is also really important to recognize, and we score, so I don't want to undermine even ourselves here, right? But it's really important to emphasize that scoring, especially when you look at it just as a single number, does not capture the complexity of any given institution. I like to use an example here, and it's not fair, but it's a company that everyone knows, and so it's kind of easy to talk to, which is Tesla. Tesla does some absolutely fantastic work around the electronification of the automobile industry, and is really driving, quite frankly, that change in electronification in the automobile industry. But it has some very challenging business practices as well, particularly around the governance model. You tend to have a very, very charismatic CEO who has a danger of running the business on Twitter ahead of his board, knowing that he's making various decisions, which leads to governance score reduction. And you've got some questionable practices around the mining for the lithium batteries for the cars, which take place in emerging markets where perhaps the employee rights are not so robust, and so on and so forth. And so as a sustainable investor, there is a decision to be made, which you have to determine based on what outcomes you want to drive around whether or not you want to deploy capital to Tesla. Does Tesla, with all of those different issues that I just described, and no doubt a number of others, meet your requirements for sustainable investment or not? And a single overall score of ESG overall for Tesla does not tell you that answer. It will have a combination of the things that Tesla does really well and a combination of things which are more problematic at Tesla. And you may be very, very happy to forego the things that Tesla doesn't do very well, or you may feel they overrule the things that Tesla does well. But it is an obligation for asset managers to be able to establish their own sustainable investing strategy. What outcomes are they trying to drive, and what data and scoring is useful to help them drive that outcome? And the score should not dictate whether or not you deploy capital towards a company or not in and of itself. So I think really important issue associated with scoring, and scoring does help make sense of data for companies, but it doesn't reduce the need to shoulder the burden of your own sustainable investment strategy. The other data set that we have, which of course is incredibly closely related, indeed is interrelated with our ESG data on companies, is our capital raising data, or sustainable finance related data. So we've been capturing green bonds for a very long time. Refinitiv has a very rich history in capturing deals, M&A deals, equity capital markets deals, new bond issuance, new syndicated loan issuance, and we've been doing that for many decades, and creating league tables out of which underwriters underwrite the most capital, et cetera, et cetera. And in this space, we've been capturing green bonds for a very long time, and more recently, we've been capturing broader ESG bonds. That might include bonds which don't meet the criteria of being green. We partner with CBI, the Climate Bond Initiative, around determining what is green and what isn't, which is based on the ICMA principles of green bonds. But of course, there are other types of securities in this space: transition bonds, climate bonds, social bonds, COVID-19 bonds, none of which have actually as robust clarity around exactly what they mean and what's in and what's out as green bonds do. And that needs to change. That needs to mature too. And we're part of those conversations as well. It's important that we do get that clarity. But equally, by missing out on everything which isn't a green bond, you're missing out on a lot of capital being raised, which supports sustainable outcomes. And so, driving for that clarity, being able to identify those types of deals where use of proceeds are being used for very obviously green purposes, or indeed, more recently, example of the NL transactions, which are the sustainability linked bonds, in which the issuer itself needs to meet certain KPIs in order for the coupon to remain appealing for investors, basically. So, really, really interesting dynamics in terms of the maturity of the space there. And in fact, we will be, Refinitiv will be creating at the end of the second quarter our first sustainable finance quarterly review, investment banking review, which will talk to what is essentially the wallet in the market for sustainable financing across all those different products, all those different types of capital being raised, all of which, of course, investors can choose to invest in. So I'm looking forward to releasing that to the market in the coming weeks. So Sonia, there we go. That's a little bit of an overview. Hopefully interesting enough, and very open to take questions.
And very self-explanatory, as you mentioned. We do have quite a few questions here, but just time for a couple.
Great.
First, you mentioned social bonds, and how does the COVID pandemic change the way we think about social bonds and other ESG instruments? Is this market set to take off? And on a related note, are you seeing more demand for the S and the G data related to social and governance issues, and how are you going about getting that data together?
I think that one of the things that COVID-19 has done is drive a high degree of clarity of the fact that social and humanitarian crises cannot be avoided by the financial markets. The financial markets, the financial economy reflects the real economy, and you can't diversify away from those humanitarian and social crises. And so the more that you can, so to speak, manage to them, predict them, quantify them, internalize these externalities into the investment process, the better you are at being able to address them. And yes, we have seen a growth in the demand for social capital and also for social data. I think that's very encouraging. What's really encouraging is it doesn't seem to be at the detriment of the E side of things, the environmental side of things and the climate side of things. It seems to be an additional drive. Now, how long that takes to play itself out, I think is a little bit unclear as COVID-19 and the dynamics change in the market. But I suspect that will become the new norm. I think the really important issue is there's lots of COVID-19 funding at the moment, and some of that is not really sustainable. It's about getting companies back on their feet, which is super important and you need to do, but you also need to, of course, drive for that funding to be tied in the long run to driving sustainable outcomes as well. And so that dynamic needs to be negotiated by the markets in the coming months.
Okay, so a couple of questions that take the form of critiques, so I'll hit you with these. A lot of criticism of scoring systems. The IMF, for example, highlights that they're not correlated with performance or valuation, so that's one issue. And the other is, how do you bring down the cost of data and make it more accessible? A lot of comments on those regards.
Okay, so I think the scoring question is a really interesting question, and I'd love to do it justice, but I probably can't do it full justice very, very quickly, but I'll touch on a couple of points. One is the scores are not particularly highly correlated, but when the market is as immature as it is, when you haven't got any regulation around what good reporting looks like and around reporting clarity amongst different regions, different types of organizations, would you expect those scores to correlate highly? The second question is an open question, which is people tend to identify correlation as a good thing. Credit ratings correlated very, very highly. That didn't particularly help in the credit crisis. So I think there is a question mark over whether actually high correlation is valuable. If you think of ESG scores as more akin rather than a credit rating to something like an analyst forecast of companies' performance, it wouldn't be particularly useful if all analysts forecast exactly the same thing. The whole point is that you want a diversity of opinion around that. Now, the critical thing is that requires investors to have a high level of engagement with, well, why are the scores different? What is the methodology for this score versus how this score was arrived at? And it requires a degree of resource and engagement in that process, which of course it's probably slightly less than appealing rather than having the answer given to you. But I think that those are some of the dynamics there. But not unimportant. I suspect that over time, the scores, as the market matures, will start to come closer together. Although I do question whether or not high correlation is what is really useful here or not. So, second question you had.
I do. We have many more questions. Unfortunately, we have come to the end of our time. I'll make sure these questions reach you. And our thanks to you for a really interesting presentation, and to all of our participants for their fascinating questions. So thanks for being with us, Leon.
My pleasure. I'm happy to follow up offline on any questions that anyone has too. So thank you for having me.
Thank you.